What if the very policies designed to help you afford a home are actually making homes more expensive? Why do the same policies that worked in the 1980s fail so spectacularly in 2026? And is the government fighting inflation or quietly counting on it to solve a different problem? Let's start with an uncomfortable truth that nobody in Washington wants to say out loud. In January 2026, the United States faces an economic puzzle. Despite aggressive policy interventions aimed at reducing household costs, several key affordability metrics have moved in counterintuitive directions. Electricity costs increased by 6.7% in 2025. This matters because electricity is a non-discretionary expense. Households cannot easily reduce consumption. Mortgage down payments increased from $15,000 in 2019 to $32,000 in 2026, effectively doubling the cash required for home ownership, even as interest rates declined. Grocery inflation continues running at 3.2% year over year, eroding purchasing power for the average household. The federal deficit is projected to increase by $3.3 trillion over the next decade, raising questions about long-term fiscal sustainability. This presents an analytical challenge. Standard economic interventions, increasing credit access, reducing regulatory friction, cutting taxes, have not produced the expected price relief in critical sectors. To understand why, we need to examine the structural differences between demand-side stimulus and supply-side constraints. This is not unique to current policy. It's a recurring pattern in economic history when policymakers attempt to address price problems through monetary and fiscal expansion rather than capacity expansion. Current policy interventions can be categorized into two groups. Demand-side measures include enhanced credit access, such as allowing 401k borrowing for housing down payments. Tax reductions totaling $3.3 trillion over 10 years, putting more money in consumers' hands. Monetary stimulus through Fannie Mae and Freddie Mac bond purchases designed to lower borrowing costs. And direct payment proposals, such as healthcare HSA funding. Supply-side measures include regulatory streamlining for energy project approvals, trade policy adjustments including tariffs on imports, and limited infrastructure investment. The asymmetry is measurable. Approximately 85% of fiscal policy measures focus on demand stimulus, giving people more money or cheaper credit, while only 15% address supply capacity, actually producing more goods and services. This ratio inverts the policy mix used during previous successful price stabilization periods, notably the 1950s through 1960s infrastructure expansion, when the interstate highway system and massive housing construction increased supply, and the 1980s through 1990s productivity acceleration, when technology investments expanded what the economy could produce. The question becomes, can demand-side policy solve supply-side constraints? Economic theory suggests not. When you give people more money but don't produce more goods, prices simply rise to absorb the extra cash. Historical evidence provides case studies that confirm this principle. Chapter 1. Housing. The housing sector provides the clearest example of supply-demand asymmetry. In January 2026, 3 major policy interventions were announced. Authorization for 401k withdrawal for down payments, allowing Americans to tap retirement savings for home purchases. $200 billion in Fannie Mae and Freddie Mac mortgage bond purchases designed to push mortgage rates down, and a proposed ban on institutional investors in the single-family market, aimed at reducing competition from large corporate buyers. The measured outcomes were partially positive. 30-year mortgage rates decreased to 6.06%, the lowest level in 3.5 years. Goldman Sachs estimated a 15 basis point rate reduction, meaning borrowing became measurably cheaper. This is projected to increase spring home sales by 5 to 7%, helping some families enter the market. However, the broader picture reveals complications. The average down payment increased from $15,000 in 2019 to $32,000 in 2026. Why? Because home prices rose faster than interest rates fell. Housing inventory remains at multi-decade lows. There simply aren't enough homes for sale. And new housing starts remain below the historical replacement rate, meaning we're not building homes fast enough to meet population growth and household formation. The mechanism is textbook economics. Lower borrowing costs increase purchasing power, shifting the demand curve rightward. Think of it this way. When mortgages get cheaper, more people can afford to buy, so more people compete for homes. In a market with elastic supply, where producers can quickly make more of the product, this increases quantity without significantly affecting price. More demand leads to more production. But U.S. housing supply is notably inelastic in the short to medium term. Why? Due to several structural factors. Zoning restrictions in high-demand metropolitan areas prevent building multifamily housing or increasing density. Construction labor shortages exceed 200,000 unfilled positions nationwide. There literally aren't enough workers to build faster. Material cost increases for lumber, copper, and steel have raised construction expenses. Land use regulations create lengthy approval processes. And NIMBY opposition, not in my backyard, blocks density increases in established neighborhoods. The average timeline from planning to completion for new housing is 24 to 36 months in major metros. A developer must acquire land, get permits, arrange financing, and complete construction. This takes years. Meanwhile, policy effects on credit markets are immediate. The Federal Reserve can lower rates with a simple announcement. This creates a fundamental mismatch: instant demand increase, but years-long supply response. Let's examine a historical parallel: the Burns-Nixon expansion of 1971 to 1972. The context: Federal Reserve Chairman Arthur Burns reduced interest rates at presidential urging. President Nixon wanted economic stimulus ahead of the 1972 election. The goal was to make voters feel prosperous. Mortgage rates declined approximately 50 basis points, similar in magnitude to current policy. Housing demand increased significantly as borrowing became cheaper. The outcome? Initial economic acceleration in 1972. Nixon won re-election. But then the inflation rate increased from 3.3% in 1972 to 13.5% by 1980. Real wages, purchasing power adjusted for inflation, declined for median workers throughout the decade. It required Paul Volcker's 1979 to 1982 high-rate intervention to stabilize, which involved pushing interest rates above 15% and causing a severe recession. Studies by Meltzer in 2005 and Silber in 2012 identify the policy error: stimulating demand in an economy already near capacity without corresponding supply expansion. You can't make people richer by printing money if you're not producing more goods. Now let's examine the retirement account dynamics mathematically. Consider $50,000 withdrawn from a 401k at age 35 for a home down payment. Assuming a 7% annual return over 30 years, a conservative long-term stock market estimate, the opportunity cost at age 65 is approximately $380,000. This is the compound interest effect. Money grows exponentially over time, and early withdrawal eliminates decades of growth.
Research from the National Bureau of Economic Research demonstrates that early retirement account withdrawal correlates with significant reductions in retirement security. This is particularly concerning for cohorts facing below-replacement Social Security benefits, younger workers who will receive less generous government pensions than current retirees. The net effect analysis reveals the paradox. Lower rates plus increased credit access equals higher purchasing power. More people can afford to bid on homes, but fixed housing inventory plus higher purchasing power equals price inflation. The same limited number of homes with more buyers competing means higher prices. So higher prices minus rate savings equals net affordability decline. Here's a concrete example calculation. A $400,000 home at 7.5% rate results in a $2,796 monthly payment. A $450,000 home at 6.06% rate results in a $2,723 monthly payment. The rate reduction enables purchasing a more expensive home for approximately the same payment, but does not improve fundamental affordability. You're paying the same monthly amount for a house, but the house itself costs more. Markets with the most constrained supply show this most clearly. San Francisco, New York, and Boston show the largest price increases following rate reductions. This is consistent with inelastic supply models, where supply cannot expand quickly. All the benefit of cheaper credit goes to sellers, not buyers. Chapter 2, Energy. The energy sector demonstrates how technological change can create supply bottlenecks even during production expansion. Several policies were implemented. Lifted restrictions on federal land drilling, opening more acreage to oil and gas extraction, expedited approval for fossil fuel projects, reducing environmental review timelines, resumed liquefied natural gas export authorizations, allowing more domestic gas to be sold overseas, halted 5 Atlantic offshore wind projects, canceling renewable energy developments, and extended operational permits for aging coal plants, keeping old facilities running longer. The production data shows record output. U.S. crude oil production reached 13.2 million barrels per day in January 2026, the highest in American history. Natural gas production is similarly at historic highs. By conventional logic, more production should mean lower prices. However, consumer cost outcomes tell a different story. Residential electricity increased by 6.7% in 2025, adding roughly $116 to the average annual household bill. Natural gas heating increased by 9%. Regional variation was dramatic. Washington, D.C. saw a 23% increase, Indiana 17%, with the national average at 6.7%. Why didn't increased production lead to decreased prices? The demand-side variable provides the answer: data center expansion. The growth metrics are staggering. Data center electricity consumption increased from approximately 4% of U.S. total in 2023 to a projected 8% by 2027. This is doubling in just 4 years. AI model training requirements exceed 1,000 megawatt hours per large language model, equivalent to powering 100 homes for a year. Cryptocurrency mining adds approximately 25 terawatt hours annually, more than the entire state of West Virginia consumes. Geographic concentration matters. Data centers cluster in Virginia, Texas, and Oregon, regions now experiencing the highest electricity cost inflation. This isn't coincidental. The new demand is overwhelming local supply. The supply response lag creates the problem.
average construction timeline for a natural gas plant is 3 to 4 years. For a nuclear reactor, 7 to 10 years. For an offshore wind farm, 5 to 7 years from approval to operation. Even coal plant restarts require 12 to 18 months, and most retired plants cannot be economically restarted. The net generation capacity from 2024 to 2025 was effectively flat. Retirements totaled 15 gigawatts of capacity. Additions totaled 17 gigawatts. But demand growth required the equivalent of 12 gigawatts annually. So we're adding capacity, but barely keeping pace with closures while demand accelerates. Now let's examine export market integration. Economic principle: when a commodity becomes tradable on global markets, domestic price converges toward global price. Consumers in Kansas now compete with consumers in Germany. The data shows this clearly. U.S. Henry Hub natural gas increased from $3.20 per million BTU in 2023 to $4.80 in 2026. European TTF price trades around €45 per megawatt hour, roughly equivalent to $6.50 per million BTU. Asian LNG spot prices range from $12 to $14 per million BTU. U.S. LNG exports increased from 11.6 billion cubic feet per day in 2023 to 14.2 billion cubic feet per day in 2026. This is natural gas that previously stayed in the domestic market, now being sold overseas. The economic analysis is straightforward. Domestic consumers now compete with international buyers. This is economically efficient from a producer perspective. It maximizes returns for energy companies. But it raises domestic retail prices because supply that once stayed here is now globally allocated to the highest bidder. Let's examine a historical parallel. The 1973 to 1974 energy crisis. The context? OPEC imposed an oil embargo following the Yom Kippur War. U.S. petroleum production was declining from its 1970 peak. Domestic supply was shrinking. Demand growth was outpacing domestic supply growth. Americans wanted more oil than the country produced. Price controls created artificial shortages. Government prevented prices from adjusting. The outcomes were severe. Gasoline prices quadrupled within months. Consumer inflation accelerated to 12%. Affecting all goods. Economic recession lasted from 1973 to 1975. The policy eventually shifted toward efficiency and supply diversification, smaller cars, strategic petroleum reserve, investment in alternatives. Studies by Hamilton in 1983 and Barsky-Killian in 2004 emphasize price shocks are most severe when supply capacity is tight and inflexible. When the system has no spare capacity, any disruption causes dramatic price increases. Now consider the supply opportunity cost of canceled projects. The 5 canceled Atlantic offshore wind projects represented combined capacity of approximately 5 gigawatts. Equivalent annual generation would have been 20 terawatt hours. This is sufficient electricity for roughly 2 million homes. The construction timeline meant they would have been operational between 2027 and 2029, exactly when demand projections show growing strain. The levelized cost of energy comparison shows the trade-off. Offshore wind costs $89 per megawatt hour. Natural gas from a new plant costs $68 per megawatt hour. Coal from existing plants costs $42 per megawatt hour for operations, but $112 per megawatt hour for new builds. Short-term economics favor fossil fuels. They're cheaper right now. Long-term capacity requirements favor diversification. You need multiple sources to ensure reliability and moderate prices. The consequence? Summer 2025 saw 34 grid stress events,
compared to 18 in 2023. This required demand reduction protocols in 7 states, essentially asking consumers to reduce usage during peak hours to prevent blackouts. Chapter 3. Healthcare. Healthcare costs represent 17.3% of U.S. GDP, the highest ratio among developed economies. This means nearly $1 in every 6 spent in America goes to healthcare. Policy interventions in this sector must account for adverse selection dynamics, the tendency for insurance markets to unravel when high-risk and low-risk people separate. The proposed framework from January 2026 included replacing ACA subsidies with fixed health savings account contributions, converting income-based help to flat payments, reinstating cost-sharing reduction payments to insurers, giving insurers money to offset discounts. Implementing most favored nation drug pricing linked to international reference prices, paying what other countries pay, and reducing intermediary fees in pharmaceutical distribution, cutting out middlemen. Health economists identified several analytical concerns. First, the adverse selection risk. When subsidies convert from income-scaled to fixed payments, individuals face different incentive structures. Here's why this matters. Standard insurance theory from Akerlof in 1970 and Rothschild-Stiglitz in 1976 shows information asymmetry leads to market unraveling. The sequence works like this. Healthy individuals find coverage pricing unattractive. They know they're unlikely to need much care, so expensive comprehensive coverage feels wasteful. Insurer risk pools become disproportionately high cost. Only sick people stay enrolled. Premiums rise to reflect higher average risk. Insurers must charge more because their enrolled population uses more services. Additional healthy individuals exit. The rising premiums push out more low users, and the market approaches failure. Eventually, only the very sick remain at unsustainably high prices. The empirical evidence supports this theory. The pre-ACA individual market showed declining enrollment from 2008 to 2013. The system was slowly collapsing. The post-ACA individual market achieved stable enrollment from 2016 to 2024. The variable that changed? Guaranteed subsidies maintaining balanced risk pools. By ensuring healthy people could afford coverage, the market stabilized. Natural experiments at the state level confirm this. States that reduced insurance regulation from 2018 to 2020, Idaho, Tennessee, and Iowa, introduced short-term duration plans without pre-existing condition protections. The result? 15 to 22% increase in comprehensive plan premiums over a 3-year period. The mechanism? Risk pool deterioration. Healthy people left for cheaper plans, sick people stayed in comprehensive coverage, and premiums rose. Age-specific vulnerability matters greatly. Ages 55 to 64 represent the highest insurance utilization cohort. Average annual healthcare spending for this group is $13,000 to $15,000. They're Medicare ineligible, not yet 65. They have higher prevalence of chronic conditions than younger people, and they have the highest sensitivity to premium increases because many are on fixed incomes or reduced work hours approaching retirement. If enhanced subsidies expire as scheduled in December 2025, a family earning $66,000 would see premium increases from approximately $6,400 per year to $19,200 per year for an example Silver plan. The CBO estimates 5.1 million people would face unsubsidized costs. For many, this means dropping coverage entirely. Now let's examine pharmaceutical pricing dynamics. The most favored nation concept
links U.S. prices to the lowest price negotiated by other OECD countries. The estimated U.S. price reduction is 50 to 85% for top Medicare drugs. This would dramatically lower out-of-pocket costs for seniors. However, there's an economic counterargument about innovation incentives. Global pharmaceutical R&D expenditure totals $240 billion annually. The U.S. market represents 45% of global pharmaceutical revenue. American consumers essentially subsidize drug development for the world. The question becomes, does price reduction affect innovation incentives? Demasi and colleagues estimated in 2016 that the average cost to develop a new drug is $2.6 billion, including failures. Most drug candidates fail in testing, so successful drugs must recoup the cost of failures. CBO analysis from 2021 found 8 to 15% reduction in U.S. pharmaceutical revenue correlates with 0.5 to 1.5% reduction in R&D spending. The relationship isn't one-to-one, but it exists. This creates an economic tension. Lower prices improve access for current patients, but may reduce long-term innovation that benefits future patients. This trade-off exists in all administered pricing systems. European countries with lower drug prices also have fewer pharmaceutical companies and less drug development. Finally, consider the structural constraint of provider availability. The United States has 2.6 physicians per 1,000 population. Germany has 3.6. Austria has 4.3. We have fewer doctors per person than comparable wealthy countries. Nurse practitioners and physician assistants are filling the gap, but face scope of practice restrictions, state laws limiting what they can do without physician supervision. Medical residency positions have been federally capped since 1997. Congress limits funding for training new doctors. The implication? Even with perfect insurance design, provider shortage constrains access and maintains upward price pressure. You can't see a doctor who doesn't exist. Scarcity drives up prices regardless of payment systems. Tax policy in 2025 to 2026 illustrates the fundamental tension between short-term stimulus and long-term fiscal sustainability. The Working Families Tax Cuts Act passed in July 2025 with these major provisions. Extended individual tax reductions from 2017 legislation that were set to expire. Enhanced child tax credit from $2,000 to $2,500 per child. New savings account provisions for families. The estimated 10-year cost is $3.3 trillion, according to CBO baseline projections. The distributional impact, according to Tax Policy Center analysis, shows the bottom quintile, poorest 20%, receives average benefit of $120 per year. Middle quintile receives average benefit of $1,470 per year. Top 1% receives average benefit of $61,000 per year. Top 0.1%, the wealthiest 1 in 1,000, receives average benefit of $244,000 per year. The fiscal mathematics reveal the sustainability concern. The 2026 federal budget projects revenue of $4.9 trillion, spending of $6.8 trillion. This creates a deficit of $1.9 trillion. The government spends nearly $2 trillion more than it collects. Public debt totals $28.4 trillion. Debt to GDP ratio reaches 122%, meaning government debt equals 122% of everything the economy produces in a year. Historical context shows this is unusual. Previous debt to GDP peaks occurred post-World War II in 1946 at 106%. The current trajectory shows 122% in 2026, rising to 166% by 2034 per CBO baseline. With tax cuts fully phased in, the Committee for a Responsible Federal Budget estimates potentially 185% by 2034. This matters because high debt constrains future options and creates risks. Now let's examine debt inflation dynamics. Economic principle. High government debt creates inflationary bias in policy. Here's the mechanism. Governments facing high debt-to-GDP ratios have three theoretical options. Raise taxes, which is politically costly. Voters punish politicians who raise taxes. Reduce spending, which is economically painful. Cutting programs creates immediate hardship and opposition. Or allow moderate inflation, which reduces real debt burden. This is the least visible option. The mathematical illustration shows how this works. Nominal debt totals $28.4 trillion. If inflation runs at 3% annually, the real value reduction is $852 billion per year. The effect? Debt burden declines in real terms without explicit policy action. The government still owes $28.4 trillion in nominal terms, but that amount can purchase less, so the burden is lighter. This represents wealth transfer from creditors to debtors. Bondholders and savers see their wealth eroded. The government and borrowers see their debt burdens lightened. Let's examine a historical parallel. Post-World War II debt reduction from 1946 to 1970. The context: debt to GDP ratio declined from 106% in 1946 to 35% in 1970. This was achieved through a combination of several factors. Economic growth averaging 4% real. The economy expanded faster than debt. Moderate inflation averaging 2.5%, eroding debt's real value. Financial repression through Regulation Q, which kept interest rates below inflation. Savers earned negative real returns. And fiscal restraint, with deficits averaging 0.2% of GDP, near balanced budgets. Reinhardt and Sabrancha calculated in 2015, 3 to 4% of GDP annually was transferred from savers to government through negative real interest rates during this period. This was a deliberate policy to reduce war debt, and it worked, but at savers' expense. A key difference: the 1946 to 1970 period included strong productivity growth and expanding working-age population, more workers producing more goods. Current demographics are less favorable: aging population with slower productivity growth. The revenue offset mechanisms show how tax cuts were partially funded. To partially fund tax reductions, 2025 legislation included SNAP reduction of $187 billion over 10 years, cutting food assistance. Medicaid eligibility tightening of $117 billion over 10 years, fewer people qualifying for health coverage. Discretionary spending caps of $230 billion over 10 years, limiting annual appropriations. The net fiscal effect shows the imbalance. Spending cuts total $534 billion over 10 years. Tax reductions total $3,300 billion over 10 years. Net deficit increase equals $2,766 billion. Nearly $3 trillion of unfunded tax cuts. Debt service implications compound the problem. Average federal interest rate in 2026 is 3.1%. Annual interest on $28.4 trillion totals $880 billion, nearly $1 trillion just in interest payments.
By 2034, per CBO projections, this reaches $1,370 billion annually. This becomes the third largest federal expenditure after Social Security and Medicare. The economic consequence: growing share of budget consumed by debt service reduces fiscal flexibility for other priorities. Every dollar spent on interest is a dollar that can't fund infrastructure, education, defense, or anything else. Chapter 5: Food Prices. Food costs provide a case study in how trade policy and transfer payment reductions interact with household budgets. The current tariff structure on food imports includes fruits and vegetables at 3 to 12%, depending on category, dairy products at 8 to 20%, tropical products like coffee and bananas at 0 to 2%, recently reduced from 5 to 8%, processed foods at 4 to 7%. The price impact analysis by the Center on Budget and Policy Priorities estimates tariffs raise food prices by 1.9% overall. Produce specifically sees a 3.3% increase. The mechanism: reduced competition allows domestic producers to maintain higher prices. When imports cost more due to tariffs, domestic producers can charge more without losing customers. Import dependency matters because the U.S. produces domestically approximately 85% of consumed vegetables, only 55% of consumed fruits, 0% of bananas, coffee, and cocoa. We grow none of these, and roughly 40% of seafood. For products with limited domestic substitutes, tariffs function as a consumption tax with minimal protective benefit for domestic industry. Americans will pay the tariff because there's no domestic alternative. Now consider transfer payment reductions. SNAP, the Supplemental Nutrition Assistance Program, commonly called food stamps, was modified in 2025 legislation. Eligibility requirements were tightened. Work requirements were expanded. State matching requirements were increased. Total reduction equals $187 billion over 10 years, representing approximately 20% reduction in the program. The impact on household budgets is substantial. Example case: single parent, one child, income $28,000 per year. Previous SNAP benefit was $536 per month. Modified benefit is $292 per month. Net reduction totals $244 per month, or $2,928 per year. Macroeconomic context shows this matters. Households receiving maximum SNAP benefits, 40% spend benefits within the first week of receipt. This indicates benefits roughly match actual food need, not excess. The reduction creates genuine consumption constraint, not reduction of excess spending. Measured outcomes from USDA Food Price Outlook in October 2025 show food at home inflation running at 3.2% year over year. This is above general CPI inflation of 2.7%. Food is getting more expensive faster than other goods. Staple categories, including eggs, dairy, and grains, show 4 to 6% inflation. The net effect calculation for median SNAP recipient household shows food price increase of positive 3.2%, benefit reduction of negative 20%. Combined impact equals roughly 23% reduction in purchasing power. Economic observation. Policy creates opposing forces: higher prices from tariffs, lower assistance from budget cuts. These compound rather than offset,
creating significant affordability pressure on lowest income households. Synthesis: structural constraints. Let's return to the central analytical question. Why have demand-side interventions not produced expected price relief? The policy inventory shows clear patterns. Demand stimulation includes credit expansion for housing and healthcare, making borrowing easier, tax reductions totaling $3.3 trillion, putting money in hands, direct payments and subsidies, cash transfers, monetary accommodation, lower interest rates. Supply expansion includes regulatory streamlining, faster approvals, trade policy adjustments, tariff changes, infrastructure investment, minimal actual spending. The asymmetry is clear: overwhelming focus on demand, limited attention to supply. Supply-side constraints can be mapped across sectors. In housing, construction capacity is insufficient due to labor and materials shortages. Regulatory environment features restrictive zoning in high-demand areas. Time lag from planning to completion averages 24 to 36 months. In energy, generation capacity is flat despite demand growth. Infrastructure includes aging grid limiting transmission capacity. Investment cycle requires 5 to 10 years for major projects. In healthcare, provider shortage results from physician supply constrained by residency caps. Infrastructure problems include rural hospital closures, reducing access. Training pipeline requires 7 to 11 years to produce a new physician. In food, agricultural capacity is constrained by land, water, and labor availability. Import dependency reaches 30 to 40% for fresh produce. Trade barriers, including tariffs, limit competitive pressure. The theoretical framework clarifies the mechanism. Classical economic principle: price reflects marginal cost of the next unit produced. When supply is constrained, represented by a vertical or near-vertical supply curve, increased demand raises price without proportional quantity increase. More buyers bidding for the same goods drives up price. Historical precedents show when this works and when it fails. Successful demand stimulus occurred in 2008 to 2009 recession response, when the economy was below capacity and stimulus was absorbed by increased production. Factories were idle and workers unemployed. And 1961 to 1964 Kennedy tax cuts, when productivity growth accommodated expansion. Technology improvements increased output. Unsuccessful demand stimulus occurred in 1971 to 1972 Burns-Nixon expansion, when inflation resulted from stimulus absent capacity growth. Economy was already near full employment. And 1965 to 1968 Vietnam War spending, which created inflationary pressure from demand exceeding capacity. Too much money chasing too few goods. The pattern is clear. Demand stimulus is effective when spare capacity exists. It becomes counterproductive when the economy approaches supply limits. Current capacity indicators for 2026 show housing inventory at 40-year low, fewest homes for sale in decades. Electricity with summer peak demand within 10% of generation capacity in multiple regions, system operating near limits. Healthcare showing primary care physician wait times at record highs, not enough doctors. Labor market at 3.9% unemployment, near full employment. Most who want jobs have them. Assessment: U.S. economy is operating near multiple supply constraints simultaneously. The empirical observation reveals correlation between demand-side policy interventions and price relief is weakly negative or neutral in constrained sectors. The policies aren't working because they're addressing the wrong problem. Sectors showing price stability are those with excess capacity, such as manufactured goods, where global supply exceeds demand. Factories in China, Vietnam, and elsewhere can produce more, so increased demand doesn't spike prices. Medium-term outlook. Let's examine fiscal dynamics over the next 6 to 9 months. Baseline scenario projects inflation stabilizes near 2.5% to 3%, elevated but not accelerating. Federal Reserve maintains rates, no dramatic changes. Modest real wage growth continues. Purchasing power edges up slowly. Deficits continue accumulating, adding to debt burden. Stress scenario envisions inflation accelerates above 3.5%, price increases speed up. Bond market demands higher yields. Investors require compensation for inflation risk. Federal Reserve forced to raise rates to prevent inflation spiral. Recession risk increases substantially. Higher rates slow economy. Federal Reserve FOMC meetings occur every 6 weeks and represent critical junctures. If inflation remains elevated, rate increases become likely despite political pressure. Historical reference provides cautionary tale. Volcker's 1979 to 1982 rate increases required to break inflation resulted in federal funds rate reaching 20% peak, unprecedented borrowing costs, unemployment hitting 10.8%, severe job losses, 2 recessions within 3 years, economic pain. The current situation differs from 1970s in key respects. Energy situation improved. U.S. now net energy producer versus dependent. Manufacturing more globalized. Supply chains span continents. Labor has weaker union power, less wage price spiral risk because unions can't force wage increases that feed inflation. But similarities exist. High government debt creating inflationary bias. Demand stimulus amid supply constraints. Political pressure on central bank independence. Policy alternatives. Economic theory suggests supply-side interventions would more directly address affordability. For housing, federal preemption of restrictive local zoning could unlock dense development. Direct federal housing construction programs could add supply quickly. Immigration reform could address construction labor shortage by expanding worker visas. For energy, accelerated transmission infrastructure investment would allow electricity to flow from where it's generated to where it's needed. Long-term contracts for diverse generation sources would encourage investment. Grid modernization for distributed resources would enable rooftop solar and batteries. For healthcare, removal of residency caps would train more physicians. Scope of practice expansion for nurse practitioners would let them do more without physician supervision. Immigration pathway for foreign-trained physicians would leverage global talent. The constraint. These interventions require larger upfront capital investment, spending money before seeing results, longer time horizons of 5 to 10 years beyond electoral cycles, political coalition building across jurisdictions, federal, state, and local cooperation, and acceptance of delayed gratification, current voters funding benefits for future residents. Electoral cycles of 2 to 4 years misalign with supply-side investment timelines of 5 to 10 years. This creates systematic bias toward demand-side interventions with immediate visible effects. Politicians face re-election before supply projects complete. The 2026 affordability paradox emerges from fundamental economics. Demand-side interventions address symptoms but not causes when binding constraints exist on the supply side. The summary equation is simple. Increased purchasing power plus constrained supply equals higher prices. This relationship holds regardless of political orientation or policy intentions. It's not ideological, it's arithmetic. Forward-looking assessment without substantial supply-side investment suggests current policies likely produce continued price pressure in constrained sectors, growing fiscal imbalances adding to national debt, eventual monetary tightening requirement when inflation persists, potential economic downturn within 18 to 36-month horizon. Alternative pathway requires multi-year commitment to capacity expansion, acceptance of short-term costs for long-term benefits, sustained political will across electoral cycles.
Historical precedent shows this is possible. The interstate highway system from 1956 to 1992 took 36 years. Rural electrification from 1935 through the 1960s took 30 years. Post-war housing expansion from 1945 to 1965 took 20 years. All required decades and consistent policy commitment across multiple presidential administrations. The fundamental question facing policymakers: can democratic systems with short electoral horizons sustain long-cycle investments required to address structural supply constraints? The 2026 experience suggests this remains unresolved.